Hey guys, this is Darren with Arbitrage Trade. It is time for Deep Dive with Daniel Hopwood. And we both decided to wear hats today. His because, well, it's basically really early morning for him. Me because when we did After the Bell, there was a guy who had the nerve to wear Arkansas Razorbacks. Some of you guys will understand why that is a problem this week. So anyway, let's don't talk about that in this one too. But Daniel, you brought something that kind of gives retail hope. I mean, all we do here is how, basically retail is dumb, like dumb apes, and retail is doesn't have all the tools they need, that they totally get dominated, and that basically, and it makes sense because the investment guys don't want to take money from other investment guys as far as these brokers go because they're buddies. So they want to take it from the retail. And they'll just shake and shake and shake until they can get it from retail. I mean, that's an oversimplification, but what your blog this week is why retail traders can outperform hedge funds, which we all love to hear that. All the apes probably standing up right now and
Just
applauding. Yeah,
ooh.
yeah. you're, gonna, you're gonna dumb it down, aren't you? But we eat crayons, right? I mean, that's what we do, supposedly. All right, so you're saying that retail could be the smartest players in the market if they utilize what are you saying?
They have the potential because the way in which retail can trade versus an institution or a hedge fund is just different because the rules that retail can play by, they pick versus a hedge fund or institution has rules that they have to play by. And I'm not even talking about regulatory rules. They're kind of these unspoken rules that we can get into that, as a result have kind of made them this thing that don't actually make the investor, as in the person putting in the money, really any money.
Gotcha. You kept bringing up, and by the way, when we went through this whole GameStop AMC thing, what seemed to be a problem for the hedge funds and anyone else was the fact that it was volume. It was a bunch of us communicating with each other through social media and convincing each other when they were trying to convince you that this was a bad investment. There was a bunch of us kind of being support for each other. So I think it's volume of people uh, can overwhelm sometimes, and that's what happened, I think, and that's why they ended up taking the famous take the buy button away, which several of the brokers did do. They had to, and that's why we lost. Who was it at the time? We did lose one of the hedge funds, and basically, I feel that trash is still out there being passed around. But
Wait, what was this removal of the buy button? I'm not aware of this.
oh, yeah. There was a point where brokers took away your ability to buy AMC and GME and
Oh, yeah, I
a lot
do.
of the other meme stocks. It was sell only, and that's pretty much what started the ape community. Just grew and grew and grew, and about hey, that's not fair. And then of course, then they had the whole committee that went and talked to all these people. Uh, what's his name though? Oh shoot! Well, we don't have time for me to figure that out. But they did bring up Mr. Ken Griffin at Citadel, and they all talked and testified, etc. As they were probably patting each other's backs after the court. So who is this guy? You said I know I butchered it probably when I did it for the daily. This Qualamagi, is that right, or is it?
Yeah, Koala Maggie. It's
Okay.
I don't know the guy's, or I should say I don't know how to say the guy's actual name. He's like a Swedish guy that trades
Yeah.
U.S.
Okay.
markets. That's
Oh,
just like
okay.
his Twitter handle and his
Yeah.
YouTube, how people refer to him. And to be fair, when talking about him, this guy is more of the exception than the
Right.
rule,
Of course. Of
right?
course. Yeah.
But he turned more or less like $10,000 into $100 million. Now he did this over a course of, I'd say, like 10 years.
Okay.
So it's not, some crazy overnight success story. He did blow up 3 different accounts over 3 years, was kind of a break-even trader for like 2 years or so. And then he started, making money, right? and he's kind of been a model for, the what I would call the swing trading community. And to be fair, these aren't your average traders who are just on Robinhood casually buying and selling stuff, right? These are people who have spent thousands of hours studying whether it's charts, financials, whatever their strategy is, having real risk management strategy, entry, exit, criteria for their stocks, to get in and out. But if you look at his returns in the earlier years, they were in the thousands of percent, right? And so it's just an interesting case study of how a retail trader, and there are other stories like this, specifically kind of with this strategy that he looks at, just because of the way it works, of people that make well outperform the market and even hedge funds every year. And it's kind of interesting why someone like this can do that, even though that this person in particular, was the way he made money to be able to have a trading account is he was like a night security guard or something, right?
Wow.
So no Bloomberg terminal, no Princeton degree, no hedge fund flow data kind of stuff, just actual hard work.
So somehow he found that edge, which is one of the things you talk about, little guy having an edge, because they have flexibility, they have agility, they can make things happen quick, while the big hedge funds are slower in what they do. I think those are a few things that you mentioned, um, and that we can be focused on a couple of stocks while the hedge funds are focused on a million different stocks and everything, and ETFs and everything else that they're trying to push. Um, well, they're not supposed to talk to each other. Of course, we know that they've gotten in trouble via WhatsApp and all these other things, that they actually do talk to each other and maybe collaborate on trades. But it was funny because when the AMC GME thing happened, some of those guys were complaining about, us doing things as a whole and having our own little tech sessions where we talk about stocks via Reddit and via whatever. I mean, what was the stock one? Stock something. But yeah, apes got together and we discussed a lot of just one or two stocks, and I think that's also gave us an advantage specifically in that. And I think at one point it was just they were throwing everything at it, we were throwing everything at it, and eventually the prices came tumbling down. Um, so let's move on to the next section here. You said that it used to be that it was an exclusive club, I think, and now that retail has access to everything, and then the whole partial shares and everything else came into play. Social media came into play, so it's just a different ball game now. So you want to expand on that?
Yeah, so I mean, once upon a time, in here it talks about prop desks, and for those people that don't know, pre '08, a prop desk was essentially hedge fund inside of a bank. Goldman, JPM, Morgan Stanley. You could honestly debate that they still have them. They just operate differently.
Right.
Like just under that original way they operated is now technically illegal. But essentially, it was a hedge fund within one of these banks that traded the firm's money to make money for the firm, right? And once upon a time, if you ever hear about traders that were on the desk prior to '08, a lot of them were in these prop pods, and they kind of actually made money back then, just because of kind of the propriety of where that group sat with all of the even though internally, right? I know people don't like this term, but internally it's called the Chinese wall. Information is not supposed to flow from the analysis, the research side, to the investment banking side, to the investing side. But we all know it was happening, right? And these people, their only job was to make money for the firm, so they could take any position based on any of the information that they know to make money for the firm, to make more money, which is obviously a conflict of interest, right? And once upon a time, even back in '08, they had way more information, whether it was with the Bloomberg terminal, just the way the bank was receiving information and not flowing it through to the public. But as you have, charting platforms like TradingView pop up, there's even, I'll call it bad Bloomberg alternatives when it comes to things like Koyfin, or there's things called like the Godel terminal now. But pretty much, even with ChatGPT, pretty much any information that a hedge fund could have, you could have now at your fingertips. And yes, you're never going to beat a quant firm, right? Like you just, like, if you read about the book, The Flash Boys, right? They built fiber optic cables through mountains to get information somewhere 0.1 second faster, right? So, I'm not aware of any successful, retail quant stories, but a lot of these hedge funds, for someone to invest, they got to sell you something sexy, right? It's like, oh, we have a delta hedge, gamma neutral, long short fund strategy, so that no matter what, we're always incrementally going up. But as you know, with options, they're decaying leverage products. So it's very hard to, manage those positions, rolling them, looking at markets globally, and have successful returns, which is like, there's definitely portfolio managers within hedge funds that outperform. But when you look at the whole of the hedge fund, very few outperform every year, let alone on a consistent basis. And back to I just want to kind of touch on your point of like why, how it's different for retail is that they can sit out of the market when things aren't going their way. If they want to just trade the NASDAQ 100, they can only focus on stocks in that. And they can pick whatever setup they want, right? And so, for this particular person, they will call Maggie. He really trades two setups, which is a breakout and an episodic pivot. So episodic pivot is when company does really well in earnings and you look at a gap up and you go, oh, I think that'll be a runner for a few months. And you make this trade and you hope it runs, and you have a lot of entries on a lot of different stocks. You might get stopped out of some with the hope that those winners are bigger. But if you just told someone you did that for your fund, or the other trade he does is a breakout, right? Literally just looking for a break of a trend line on a stock that's been trending momentum up. It's not really like the sexiest thing, like if someone's like, oh, but I want that quant fund, right? Because that's cool to talk about at dinner, where this guy is trading breakout lines is kind of a harder thing to sell. And then on top of it, if a fund did want to do this, they'd have to be a smaller fund. You can't be $1 billion fund trading breakouts and episodic. I mean, you can, but the risk management is much more difficult compared to how this guy manages risk. There is an advantage of, you can, it's kind of the KISS model of you can keep it simple, and that can actually make you more money, right? Versus to be a hedge fund, you kind of got to be complicated. If not, you're never going to get any money from anyone.
Yeah, I mean, I think there's a lot of family offices out there that could be doing that kind of trading. The higher risk, no regulation type funds that are out there, the shadow banking, et cetera, et cetera. So yeah, it is interesting to see how it's kind of morphed over the years as technology has become more available to everyone, I guess. So it's kind of a counterpunch thing that we continue to do. So I think the next one, of course, is going to be the quantum, as you talk about, and then once it becomes a tool that retail can buy, the quantum computers, when it gets to that point. So it's always going to be evolving, that's for sure, and always moving. And as Buffett says, up and to the right. So it's just a matter of where we fall in there. But you did say, and you mentioned what we do here, which is important because it is a way to kind of fight fight the what the market does, because we have an algorithm that actually trades for you. You don't have to think about it. We say you can sleep while you trade, and when we go to 24 hours, that's really going to be an advantage. 24-hour markets. So just kind of talk about that. What Royce has done, pretty much has created what a system that the big guys use, if not more accurate. So, yeah, go ahead and talk about that.
Yeah, so the way I look at arbitrage is it's kind of like your own little quant fund, right?
Right.
So Royce has spent years making the arbitrage system, developing all the indicators, and then now within the last 2 years, automating it so that you kind of pick the settings and then it trades for you based on those settings, right? Your what you would deem your
Mhm.
risk tolerance and like normal trading strategy. And I think, it's kind of really important to like consider that this is a pre-built solution for you. Like if you were to go and start reading books on like, machine learning and finance and like learning Python to like make all this stuff yourself, it would be
Mhm.
years before you could make something that then was able to outperform the market. First, Royce has been developing this for over 10 years. It's based on his trading strategy, and you can kind of select the parameters in which it trades. And so, the way I kind of think about my investing strategy is like, I have that as like my quant fund. I have my own trading as like my swing style trading. And then I even just do buy and hold just as a diversification to, if things aren't going well in my trading for whatever reason, then I have these other strategies that are doing well. So,
Sure.
I'm never all your eggs in one basket kind of guy, but it's you know, as technology just moves markets more and more, it's a good way for retail to hedge their risk and have another portfolio strategy kind of in their back pocket.
Yep. I mean, that's what we have here is we're not an investment house or firm. So anybody that does that uses our services are retail investors. They're not using an investment fund. They're using our algorithm in between their broker and the market. So that's how it's different here. So it's a big advantage for sure. The only thing we didn't touch on before we wrap up here is back in 2020 and 2021 ish, between there then and now, I've seen a big time change in retail using options, and I think it's because I guess they've learned over the years to use options, and I think we're at a huge part right now with options. You mentioned it earlier about how much options are getting used right now, especially in a lower volume market. So the more that we learn as a retail investor, which is that's what we are, educational financial firm, then the better retail is going to win. So, anything you want to add on there before we wrap it up?
Yeah, I mean, options placed well. It's just leverage on your whatever trade you want to make,
Yep.
and it can
Yep.
work. But it's definitely one of those things where like
Know what you're
all it
doing.
takes is one market move the wrong way, not entirely understand the product you have, for you to be underwater and then some very quick.
Yep.
So
Yep.
it's just like trading with margin. Like you got to know your strategy, when to get in and out, the true risk of what you're playing with, and as my grandpa always said, only invest what you're willing to lose.
Right.
Um, so it's trust me, I see a lot of that kind of you know options and losses stuff on Reddit, and I just don't have that degen risk tolerance, right? So when it comes to options, like Royce has been very big on cash secured puts lately. Talks about it in his
Sell.
webinar.
Sell. Don't buy. Yeah.
Yeah, he's it's selling insurance instead of buying it, and when
Exactly.
but I've been doing it as well, and it's treated me well. But when I do it, I only buy the amount that I'm willing to be put the stock. Right, I'm not going five
Yep.
times that amount
Yep.
because I'm like, well, like I don't want my entire account to be this one stock. So
Hmm. All right. Well, let's wrap this up. Basically, that's what it is. It's just retail in general. I mean, some will remain because they don't want to learn, but retail in general is getting smarter with the technologies available to actually access that information, and so it'll be fun to watch this battle between your hedge funds, your investment houses, and retail. So we definitely have a lot of fun coming up.
yeah,
Thanks for coming in. Thanks for showing this, giving retail hope those that are retail investors hope. And we'll see what you bring to us next week.
All right, talk to you later, Dan.